Live streaming is on.
All right, good afternoon, everybody. Event Trader here, and I am about to be joined by Brett Manning, who is, of course, chart trader. Brett, how are you doing today?
I'm doing pretty good. Gavin, how are you?
I can't complain, can't complain. Just a busy day. Obviously, we got a lot going on with the markets, with the earnings reports coming out, data, and of course, now we got the backdrop of this debate between Lagarde and Powell, well, not between Lagarde and Powell, but about the global economy and where we stand. So we're going to be keeping a close eye out on headlines coming across. Any initial thoughts to what we're seeing right now from the central banks with the headlines that are coming out?
Actually, I didn't see them.
Probably the most meaningful one for me, Brett, was basically we had Powell coming out saying that a 50 basis point hike
Hmm. Right.
is on the table, and I thought that that was meaningful as that just kind of maybe takes the 75 basis point hike off. I don't know if you would agree with that, but certainly seems to be corresponding from when we were when we saw this little bounce off of the lows.
Yeah, I mean, I feel like there's pretty much a locked-in consensus on 50 and then 50. So I don't know how much that's going to move things. I mean, I know Bullard was coming out talking about 75, but it
Yeah.
seems at this point we've got 99.8% on the Fed funds futures looking for 50.
Yeah, and that's obviously the base case scenario going on here, I would say. So just we'll continue to follow these headlines, certainly follow the markets as we talk and discuss what we're seeing right now currently on both the sentiment and flow data that are coming in. And definitely some notable items that we're going to break into right now. So I guess, Brett, the first thing we will take a look at is the AAII data. Now, we did see bullish sentiment improve about 310 basis points from the prior number, which was at a 30-year low, but these still remain at some pretty depressed levels. So, when you're taking a look at this data, is anything jumping off the page to you?
Well, as I caution every time we go over this data point, 1 or 2 weeks in this indicator is not significant. Never is. You look at the history. It's really only a significant contrarian indicator when it does what I call festering, when it festers at an extreme for a period where you get, like the 10-week moving average gets to a really low level. Like that's where you have this persistent buildup of a particular lopsided sentiment. And that's when you know it's translating into positioning. And even then, it doesn't have to be a contrarian indicator. It's really just a vulnerability. So if it's you've got extremely high bullishness for a period of 6 or 8 weeks on this survey, then if something bad happens, the downside move can be really drastic because you know that that's rolled into the positioning framework. Or one of the best examples to me is if you look at this bull ratio or just the number of bulls. The best example to me is early 2016, during the first half of 2016. You had two significant periods where the 5-week moving average got down to 20. So basically, it's just persistently there over a few months, and that was basically between the commodity crash and then Brexit, and anything really kind of looking like a normal environment was really a huge upside catalyst. So if that vulnerability builds up, but just seeing, there's a lot of headlines around. It's a 30-year low in AAII bulls when it hit last week under 16%. That's not tremendously meaningful.
Right. So, but it is starting to fester, though. Would
It is starting to fester. So we
right?
get a
We
few more weeks like this, then you've got a vulnerability.
now do you find that it? Okay, but I mean, a lot of the times we like to look at these data as extreme measures, and when you're looking at something like this, you see just how weak. sentiment is, and it kind of raises the question: okay, who's left to sell if everybody's this bearish, or uh, is anyone going to buy? If or obviously no one's buying if everybody's this bullish, so you don't find it at an extreme level where you're willing to use that as a contrary indicator at the moment. You'd prefer to see it fester for another week or two.
This by itself would never be meaningful to me if this festers for a while and then you get other things. We've got some other things. We've got a very hedged market right now. So if there was
Right.
a dramatic turn to positive reality, then this market rips, no doubt about it. But it doesn't have to rip in the absence of any new information based on the positioning that I see. I see you've got a defensive market right now. And you have a lot of people who are thinking that things are going to be not terribly great over 6 months from now, and that seems to be a very consensus view, which means if that picture starts to change, this market can really take off. But if that picture doesn't start to change, I mean, right now the best way that I can frame this market right now is um, y- you're getting rallies that are really just shaking out too many people crowded in short, but there's no real investment money flowing into the equities market except for in a few choice areas. There are some areas of the market. This is a split market. You've got a group of stocks that are still making 52-week highs. There's money going in there. But there's if you see like growth technology stocks breaking above a resistance level, that's when you sell that stock. It squeezes through the resistance. It's shaking out the short side stops, and that's your shorting opportunity. But you don't want to cram into breakdowns. You don't want to shorten the hole, but you want to fade things that are popping above resistance levels, especially if they're in the side of the market that's still seeing like retail call option activity.
Okay. And just continuing to watch Christine Lagarde here, Brett noting that the June meeting will be key for a potential end for the APP and potential rate path. So just keeping an eye open for that, as it does appear that the ECB continues to pull forward the potential for rate increases on their side. Probably not a surprise, though, right, Brett?
I wouldn't think so.
All right, let's continue on the path. Now, Brett, you had put out your chart book earlier today. Anybody that did not have a chance to take a look at it, I highly recommend you put it out on a monthly basis, Brett, or
It really sort of bi-monthly.
okay. And in it, Brett will detail some charts on really key macro level issues that are facing the market. And one of them that had caught your attention, of course, was this long-term trend being broken in the S&P. So, as you can see on the chart here, um, Brett had this drawn back from the beginning of the pandemic, obviously right around that March 2020 period. But for the first time, we're seeing a meaningful break below this, and really looks like it's been completely disrupted and now going into that sideways trading pattern. So, in general, Brett, how do you see patterns like this playing out?
I mean, it depends on the context. Right, I see this particular pattern. I mean, I think it should be pretty clear that I'm kind of looking for that 4,000 level test over time. But I'm perfectly aware that there can be some pretty brutal squeezes that can pop into that picture. I just That's where I see things going right now. A lateral pattern with some potential to break support levels.
Right. So basically, sideways consolidation with downside risk is how you're kind of approaching this at the moment until you see something in the pattern that changes that opinion.
That's where I'm looking right now. Yeah.
Okay. So next we got the long duration assets. This is basically how we're looking at this. The ARK innovation is arguably the poster child for long duration assets, right, Brett? So, we've seen that breaking down in a pretty firm downward trend line. It's getting close to this 50 psychological market and really just highlights the sentiment that's in here. So, Brett, when you're looking at ARC, what are some of the things that you're going to be looking for over the next couple of weeks? And would you consider firing off a trade in it?
It's possible. I mean, one of the things that I've flirted with is if I feel like we might see a break in the rise of interest rates and we might see some catalyst that could help us get some squeezing going in some of these things, then shorting SARK has been something that I've kind of flirted with in my mind because you have an extra
Shorting
advantage.
SARK, are you saying?
Shorting SARK. Yeah, so shorting the short.
Okay.
ETF. So the advantage that you get there, it's just a basic mathematical advantage, because if ARK goes sideways, SARK will go down. So if ARK goes up or sideways, you're going to win with short SARK, right? That's just the way the decay works when you have an inverse ETF. It's just
Right. And
basic
that's
math.
basically based around rollovers of the derivative contracts that are involved with following it.
No, it's the day-to-day change. So if something is at, if the underlying index is at 10 and the inverse is at 10, then the underlying index goes to 11, then the inverse goes to 9. Then let's say the underlying goes back down to 10, that right there is a 9% drop. So the inverse will only go up 9%, which gets it to below 10. So when the underlying goes from 10 to 11 to 10, the inverse will go from 10 to 9 to like 9.8. It's just basic math. It's because there's a daily reset to the changes.
Right.
So leverage or inverse, if you short them, it's one of the reasons why if you look at charts of opposites, like I remember a few years ago I put one up with like FAS and FAS. Are those the opposites for the financials? FAS and FAZ, right?
FAZ is the inverse
Yeah, you
financial.
put them. There's been a lot of periods where they've both been significantly down from any random point. Just because you have, they'll both go. So if you have the leveraged uh, proportional and the leveraged inverse, there's a lot of those pairs that you can see that will be down from inception, because anytime the underlying index just chops sideways, they both go down. It's just basic mathematics. So you can short these things, and that's why often you can't find shares short in these inverse things, because the hedge funds are all filled up with them, because it's sort of like, as long as you have deep enough pockets, eventually you're going to win.
Right. Okay. So moving along here, hedge fund exposure, Brett. This was something that was catching your attention. This is, of course, coming from Jason Geppert's Sentiment Trader page. And hedge funds are the least exposed to long equities since the early stage of the pandemic. So um, now, when we're talking about some of the bullish extremes or the bearish extreme readings that we're seeing in the AAII, and you couple this with hedge fund exposure, what's kind of popping out to you on that storyline?
Well, I mean, so again, you have this consistent theme of a very defensively positioned market, which means if the environment were suddenly to change to seem much better, let's say, we see definite signs of peak inflation and long end interest rates drop and the Fed becomes more dovish and Putin leaves Ukraine. Like if those things happen next week, this market's going to launch because it's defensive positioning. But barring that kind of change, if the 10 years headed 4%, and we're going to see this persistent kind of inflation and oil stays at 100 plus per barrel, and we start to see some declining growth numbers, which looks relatively likely, then, you know, that doesn't mean that any of this is going to change. So there may not be real institutional money taking serious positioning on the long side across, the growthy side of the market. Just because they're defensively positioned now doesn't necessarily mean that it's going to come pouring back in, but it does mean we're vulnerable to that. We're vulnerable to a big leg higher in the market if suddenly the storm clouds all clear up. I would say that it doesn't mean though that we're crowded short, I guess is the difference. We get crowded short here and there,
It's
and
it
you got
it
to watch out.
so
But
so you just view this more, and we'll get into some of the risk, but you're just viewing this as really a buyer's strike until we get some further clarity around key topics rather than people aggressively trying to lean in and short this market.
Well, you're not going to get the shorts aren't going to be forced out too far, because you're not going to get that, faucet turns back on kind of market. There's a lot of reasons for that, but we're going to get to the FMS pretty soon. You can see it's the lowest all-time expectations of global growth over the next year.
Right.
Um, the last two of those were not bottoms in the market. Like when that's how big institutional money feels, and they've done their research, and you do have an economically poor environment ahead, they don't suddenly pour in long and force all the shorts out. So you can have these sorts of you can have pessimism without it being necessarily a low. You can have persistent pessimism in a market. You just need to see that gets, if you have a market position like this and then something new comes along that seems superficially very bad, you may get everybody short and get a big squeeze. But, barring that, it doesn't have to translate into that. There's a lot of storm clouds right now on the 6 to 12 month horizon.
Right, and we'll talk about those momentarily here. This kind of builds off of that, right, Brett? Hedging on the rise. Obviously, people looking to protect themselves to the downside. I would say one thing. I don't have it in this chart, but you didn't really see that going on in the retail crowd as much, right? This is more of the Lobo, I assume, because I know in your chart books you had that call activity still pretty active for the retail
For smaller
investor.
traders, yeah.
Yeah. So this most of the hedging, as I said, you're just seeing that from the large houses rather than the smaller traders, correct?
Yeah, I mean, there's, options volume is really high on both sides, but you can see signs that there's still, that retail activity on the call side. There's still historically at an abnormally high level of call buying for smaller accounts. It's sort of where it's been for the last year and a half, but that year and a half is a historically very abnormal period.
Right, and the market from right now to 6 months ago is a very different market, right? So that
Yeah,
call activity is coming in a different environment.
sure.
All right. Margin debt rollover, Brett. You were talking about this, as you mentioned down at the bottom here. Now it's just the third time in the past 25 years where year over year change in the NYSE margin debt went from above 50% to below zero. Both the prior two times started protracted bear markets. So you want to discuss this chart a little bit?
Well, since we've built up a lot of leverage in the market over the last few years, and people levering up their capital on the long side in equities. And when you see that really spike and then suddenly flatten out completely and go, negative on a year over year basis, that's usually not uh, uh, a, f- a signal that you're done with people abandoning equities. You may be beginning people abandoning equities. Now, that doesn't mean that has to happen here. If you go further back in history, there are plenty of examples where it doesn't lead to a protracted bear market. However, we live in this period where a lot of things have evolved about the way financial markets work, particularly in terms of how retail investors interface with the stock market and what they can do with their capital and the degree to which they leverage it. So I don't really see it as an apples to apples comparison when you're looking at this data point from the 70s or the 60s or the 40s. But I think that when you're looking at it over the last 25 years, you have a relatively consistent picture. And this has been a thing that happened. This has been a thing that happened in early to mid 2008, and a thing that happened in late 2000. This kind of shift where people get really excited and levered up, and these spikes are abnormal to see this kind of gigantic, 50 to 60% year over year increase in margin debt. People levering up that much on their capital, and then having that roll over. Usually that's not something that we've quickly bounced back from. So it doesn't mean that this is going to lead to, another 2008 or another, internet bubble bust. But it is something to consider in your long-term view.
And as you can see, we're just basically at that line where in the past in 2008, obviously in 2001, we saw some further breakdown following that. But that also did kind of start to mark towards the end of those downward cycles. So, it's definitely going to be worth keeping an eye out on to see if it follows through. That's for sure. But that's definitely interesting data for us to digest. Moving along, Brett, let's take a look at the Bank of America Fund Managers Survey. And, we did see a very bearish sentiment towards growth, and we'll talk about that. I think it was the lowest in the history of the Fund Managers Survey, I believe. It just kind of goes to show, really build upon that bearish sentiment that we saw in the AAII. It was slightly more upbeat than the war shocked March survey. I guess people were still kind of trying to digest what that meant. The rumors of nuclear war were certainly prevalent when they were last doing it, but still pretty bearish overall. Stagflation predictions, Brett, they were at the highest since August of 2008. Global recession fears topped the tail risk. I can't remember the last time we saw that. And I suppose there is a little bit of chicken and the egg debate around the global recession tail risk.
Sure.
Investor risk levels were comparable to the COVID shock and great financial crisis, which just goes to show people aren't really sticking their neck out, and kind of builds upon that margin chart that you were talking about before. Global profit expectations are the weakest since March 2020, certainly higher input costs at play there. Liquidity conditions did improve, so that's important, but also, of course, it gives the Fed a little bit more runway room potentially for that rate hike. And then when we're talking about that investor risk level, it's at net 35% of investors taking lower risk. If you recall, this had been running in the range of net positive, or taking higher risk in the 40 to 50% range for most of the time. So, but we're going to get into each of these topics. But was there anything overall in the fund manager survey that you thought was key in terms of the general point?
Well, I would just say that if you have, I mean, the people that they're talking to in the survey are people who are, large fund managers, and they've become successful professionals over a period defined probably mostly by the last 10 to 15 years of reality. And that's a period when we've had, like the craziest Fed put ever. That's a period when we've had, often we've seen the dividend yield on the S&P 500 move above the 10-year or the 5-year treasury. So you've got this safety net. You've got two safety nets. You've got the Fed in there that's just been in a deflationary environment for most of that time, very willing to jump in if there's something that looks like it could, shock psychology and shock people's 401ks and, turn us back in a deflationary direction. They're very willing to talk really dovish and take action. And you've got people involved in like sovereign wealth funds and pension funds and endowment funds who need to produce some kind of return, and they'd rather be in fixed income, but they need to get a return. And if the 10 years at 0.8%, and the S&P rolls over 5 or 10%, suddenly the yield on the S&P is way above the 10-year, and that money just starts to leak over from the massive bond market into dividend paying equities. And it's been this repeated. If you take out the COVID wave, if you take out the March crash of 2020, let's just pretend that didn't happen and just look at the last 15 years. Every correction has been just really, you get 5% down, you get 10% down, and there's just this big giant safety net sitting there. And these people are used to that. That's how they're thinking, that's how they're operating. And suddenly now you've got the S&P dividend yield at 1.4%, and you've got the 10-year at 3%, double. It's nowhere near the same. You've got that fixed income money. If it needs to be there, it's getting return there. If people are shorting bonds, people are getting rid of their bond exposure, but they're building cash. And if they need to get a return, they can buy a bond. They don't have to worry about the capital gains because they got the coupon. And now that's actually a material return, well above the S&P dividend yield. And you have a Fed that's telling you, even if the market goes down 5% tomorrow, that they're still going to hike by 50 basis points. That's a completely different environment. And I think that everything you're going to see in this survey is going to reflect that kind of reality.
Yeah, the Fed put is definitely going to be an interesting chart when we get into that. But let's break down some of this. But first, we're going to take a look at the most recent Bank of America flow data that we got from April 14th. And largest outflow from equities since December 2021. Brett, when you see something like that, does that make you a little bit more confident if you're trying to short with the idea that there could be some pockets down below, or are you worried about this money being able to flow back in quickly and kind of disrupt short opportunities?
So my setups have basically been, I want people to have moments of short-term excitement, and then I want to watch that flag out. We talked about this during our strategy meeting. Somebody asked me about the setup on an S&P short, and it was just you got to squeeze above a certain level, and then I see something like a kind of like a descending triangle pattern, and I feel that energy in the market of people saying, "Oh, finally we've got upward momentum." But you know what? It starts to flag out. And those are the moments when I want to short. I don't want to be shorting breakdowns. I don't want to be shorting the market's at the lows of the day. It's trying to go lower. it's not making much progress, and then I'm, pounding into that bid, because those are the moments when it just gets too crowded, and there just happens to be somebody sitting there, with a basket and holding things, and eventually with this type of sentiment situation, people are going to get too aggressive on the short side, too levered up short term, and you're going to get, drilled with some kind of quick 1% move higher in the market. It's waiting for those things to happen, to get people excited again, like this morning right off the bat. The Dow was busting above that range high from a couple of weeks ago, and people think that's the same side, the safe side of the market. Tech starts to roll over, Dow starts to roll over. Those are the moments to short, when you've shaken out those shorts, rather than when people are hammering into the bid. So I think that kind of, the way that I look at it is this kind of sentiment backdrop, these sorts of flow data, these sorts of views persistent in the market make it dangerous to hammer into a market that's holding up but at its lows. But they make it easy when you know that it's not real money flowing in. It's just you wait for the short squeeze to end.
Right, which makes sense. Just that fast money that's going to be quick to pop
People
out to
get
the
excited.
outside. Yeah.
Yeah.
Now, let's take a look at the AUM allocation that they're looking at, because obviously, if you're looking at a 60/20, then this is off a little bit heavier in equities, lighter on bonds. Certainly, the rise in yields has led to the TLT and other bonds being offered. We are past the quarterly rebalance at this point, Brett. So, is this factoring into your trading at all?
Just the risk parity model is just a train wreck right now. So there's just we've gone again. You look at these guys who are being surveyed, and they've gone, or who are being uh, 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 statistically represented here. They've gone the last 10 to 15 years with a model where if stocks go down, bonds go up for sure. And there's been very few environments where stocks and bonds are going down together. So what's happening is just all going into cash, and it's I mean, just be aware that there's a bunch of people out there who don't understand the reality that they're living in.
All right. And the NFIB small business, that's kind of harking upon what we're seeing with the rest of the crowd. Just recession expectations are on the rise. The yen is a area where you had some recent comments, Brett, talking about how it's an island-based um, country and the economy is just not set up for this current environment. Now the yen's at a 20-year low. Certainly bringing in a questions around their yield curve control.
hmm
You got any thoughts on the yen and the broader global impact that it could
I
possibly
mean, I
have?
think I think it's really interesting how they're reacting. I mean, it's interesting that so they don't produce any natural resources. They have to import everything, and the price of everything they're importing is going through the roof, and they're devaluing their currency, and they're doing so because they don't want the long end of the curve to pop above their set level. So they're really defending their yield curve control. So basically, they're easing as their currency crashes in an environment where their economy's bound to be getting hurt by how expensive it is to import all of your raw materials to power your economy. So they're devaluing their currency and easing in an inflationary environment when they import everything. And I really don't understand how that makes sense, but it's what's happening.
Yeah, well, obviously, with everybody selling the yen, nobody else does either. Couple other things. Central banks on course to hike 253 times through 2023. And we'll talk about this in a little bit. The abrupt end of mass money printing will lead to deleveraging events, and then the Chinese imports already flashing recessionary signs. Would you agree with that last bullet point, Brett?
I mean, I don't know, and I would trust that you know
Yeah. See,
the
I would
analyst
think
here
that the
probably is more
exports would.
informed than I am.
Yeah, I would think, given that it's such an export-driven economy, that I'd prefer to see the exports flash and recessionary signs myself. But certainly something that Bank of America is watching closely. Now, Brett, just keeping an eye out here on the markets. This will probably be a perfect real time where we were just talking at the beginning of this discussion about that little spike around the Powell headlines saying 50 basis point hike. Now, this popped us up about nearly 100 points off the lows here, but we have since rolled over and taken out and got to fresh lows. So would this be a perfect real-time example of using a squeeze-induced headline for a shorting opportunity?
You mean this morning? Or so I see.
Just over the last 30 minutes, as we see that we're slipping to session lows here in the
Yeah, I guess
Nasdaq.
it's tough on that bounce to know that you're finding the right level because it's not a whole lot of excitement in a. I mean, what a oh, you got 20 points up on the S&P in that bounce. So I mean, it's a trending down. I really came in today kind of feeling like this was if the market started to roll, people would be reminded that we're in a bearish trend.
Yeah.
And that's what's happening.
Yeah, I thought that the myself, ended up making a little bit of money, but I thought that we could see a little bit of a push higher, short term because of the strength of some of the earnings that we've seen. But that it certainly seems like the leaders are being sold, like the FCXs of the world and Alcoas of the world, on results, while people are using any bounces in tech to kind of unwind positions. So it's a dynamic we'll continue to watch play out. Moving along here, Brett, here's the global pessimism chart, as we can see at the lowest ever. And you can see that dark blue line. This is the overweight equities, and you can see the light blue, the net percentage of expecting a stronger economy, has generally led that blue line. So as you can see, we were talking about this in our last meeting, which would have been in January, about how this was well above. Now we're starting to see a little bit of catch up. So you expecting to see this continue to play a little bit of catch up on those expectations and slip below that zero level?
I mean, that would, I suppose, be the default view based on the data. So, and it would make sense to me. And again, you're talking to somebody who's short the Nasdaq and the Dow at this point. And so, I mean, that's my assumption is that this money is gradually leaving
Yeah, it's
for now.
and you can kind of see that sentiment leading activity. So it's another chart that we'll want to keep in mind here. This is the same chart here.
And
Recession
I
fear.
just want to point out one other thing with
Sure.
that global pessimism chart. That this sort of level, it's an all-time low right now, but barely. And there's been other times when it's close to here. And over the life of the survey, it's. I pointed this out the other day in my notes. It's not. It does not have a history of being a contrarian indicator. It's we've hit these levels and then we've seen
And
bearish trends.
you're right. You're saying the pessimism level, and then the asset
And then we see
allocation
the bearish.
catches up. Right.
Yeah, right. So you see it's not that when you see, oh, because you're kind of, it's like one of those moments where you see, well, they're the most pessimistic ever. It's time to buy. It doesn't work that way with this. At least it hasn't worked that way with this particular indicator over the
Right.
last
So
30
you just
years.
see it more as a leading indicator rather than a contrarian
A
indicator.
bit, yeah. I mean,
Yeah.
right. So far that's been the history. I'm just trying to make sure that people understand that. Doesn't mean
Right.
that will happen this time. Past results are no indication of future performance. But historically, over the last 25 years or 30 years, it's done this a few times, and when it's done it has led to selling following this. I don't want to make everybody overly bearish right now. I don't know the future, so
Right. But
I know
all indications that you're seeing right now, and I would be
it's
in
the reason why
agreement
I
with
just
you.
keep shorting everything. Is
Yeah.
the views that I have right now are the views that I have, and maybe I'm your contrarian indicator right now in real time. It's not impossible. It's happened before. So
Right. And to be clear, I know I've been a little bit more bullish the past couple of days, but that's very short term. I tend to agree with Brett, just and we'll get into it as we talk a little bit more about some of these reasonings behind. But the global recession expectations, Brett, they're definitely on the rise here, as we could see up to 26% um, taking over the Russian-Ukraine conflict is the primary concern, as we can see from this chart. And we've started to see a lot more calls for recession. Haven't really seen it in the data yet. So, you got any thoughts on the recession, or do you not really care? You just view that as something that's going to tell us 2 months after we've been in it that we're officially in recession.
that's how it always works. You
Right.
remember Q2 of 2008 is one of the best
Yep.
ones. I mean, boy, in real time, the economy was booming.
Yeah.
And then, like a year later, you get the the Economic Cycles Research Institute comes out with the way that it's reconfigured, and then the Fed comes out with the way that it's reconfigured, and you find out that, oh no, the economy contracted like 3% that quarter, and
Yeah.
we were well into recession. There's never a time when you see a recession in real time. So, and I think that the reason why I think that an indicator like this looks like that, I think it's just like if you have a situation where oil is at 100 because of geopolitical reasons and because of massive underinvestment in production capacity, not because of crazy demand, you know, and the Fed is going to hike even if you start to see some slowdown in growth data. Like those are I think people just are doing math on what that must happen over time. Like that you can't have you know a smaller and smaller amount of money while things are getting more and more expensive without having a problem. So that I think is really the basic equation here is removing liquidity yet persistently high input costs is a difficult equation to beat. And so hopefully, that will resolve itself in a much friendlier way. We see peak inflation come down. We see the Fed get a little more dovish. And we do have, tremendous household savings, and we got a lot of consumer activity. It's possible we can weather through this. But I think that the reason why you're seeing the percentage there and the jump in recession expectations without yet seeing a decline in economic activity, I think it's probably just that sort of view of like you take money out of the system, but stuff stays really expensive. It's tends to be a problem.
Right. The chicken or the egg, because again, we got hawkish central banks as the number two one. Combined, they're 51%. We could probably throw them into the same category, I would
You should.
say.
It's
But
number two and number three equal number one.
right, exactly. With number two being probably a certainty, number one being the speculative
Sure,
part of that
exactly.
equation. So
The swing factor there.
right. Inflation remains high at 21%, but again, that inflation building up to number two. It's always funny how the domino theory works around here. With the inflation data, Brett, and any quick thoughts on that?
Just where we are in terms of inflation data.
Yeah, yeah. Obviously, we're getting those, 40-year high numbers coming out. We're going to see them receding. Do you think that that'll have a big impact on market psyche at all, or do you think that we're just at such an elevated level that people won't necessarily feel that inflation easing when it starts to happen?
Well, I mean, I think that, and I know that you and I both kind of share this view that when you come out of the pandemic around the world, you know, y everybody's just been spending everything on goods, and when they start to spend it all on services, in theory, if the inflation is being driven by supply chain issues, you should start to see that be a really positive factor in terms of easing inflation on its own, because you don't have a supply issue with going to a restaurant or whatever, going to the movies or whatever, going to a nightclub or getting a haircut, like these. But if we start to see services inflation, which we're starting to see a little bit of, like that starts to demonstrate that it's coming into expectations a bit, because people are demanding a higher rate of pay or they won't do that service because they're expecting that inflation is going to stay a problem. So if that starts to become persistently an issue, then the Fed's going to probably get even more aggressive.
All right. Any thoughts on Russia Ukraine, Brett? Game theory here and how you see this playing out?
I just think it's now settled into something that's going to be you know a very long duration thing.
Yeah, I mean, I'm kind of the impression that Putin's going to take the Donbass and Mariupol areas and just kind of carve that out. But I don't see that really ending anything myself, because it's not like he's like, okay, I'm good here. I'm just going to stick around here. We know that there's going to be another time where he's going to try to inflict further damage and go deeper into Ukraine. And at the same time, you would think that Ukraine's going to have a constant battle with them, with
Mm.
insurrections and a lot of quote unquote terrorist type activities where they're doing bombings. So it's going to be pretty ugly for a while. But how do you see it in terms of overall globalization? Do you think this is just a pause, or do you think this is a marked time and change on how the world's approaching it?
I mean, I think that China is the decider of everything here to me, and
Yeah, I
they
agree with that.
if they I mean, they can just completely support Russia and be that economic partner and look at it as, this is their resource farm right next door to fuel their rise as, the main superpower in the world over the next 2 decades or whatever. And in doing that, that would invalidate basically all kind of international organizations, and we would reset things in their minds over there. So you don't need the G20 anymore. You don't need the World Trade Organization. All these things are sort of Western institutions that can just be reshaped from the East if they're able to reorganize and maybe pull India into that kind of partnership and recenter the center of gravity of the world economy. And it's starting to look a little bit like that's kind of what they're thinking. And as long as they take that view, that rebuilding things, they can have such a long time frame for what they're doing because there's not constant elections. They don't have to worry about polls, and they can put their whole system through suffering for 5 years if it's going to lead to 30 years of what they want. So it just looks like the way they're behaving right now is really hoping to see that they would end up shifting away from seemingly supporting what's happening right now. And I haven't seen a lot of really tremendously reassuring ideas.
All right. COVID-19 obviously remains on, and asset bubbles pop. That all has part to do with the hawkish central bank inflation. So we'll continue to see how these evolve. But when you're looking at the backdrop and you're looking at headlines that could impact the markets, you definitely want to keep an eye on these. And obviously, forward-looking economic data, starting, of course, with the PMI numbers tonight and tomorrow, Brett, that could be looked at as a precursor. Moving along, inflation transitory. That actually had a small tick down from in the permanent side, small tick up to transitory. Inflation expectations were a little bit lighter in the survey as in general, Brett, but I had a feeling that a lot of that had to do more with the comparisons in terms of they're expecting it to decelerate from
Hmm.
the incredibly quick pace we're seeing. Would you agree with that?
Yeah, that and second derivative shifts in terms of commodities trends. Oil's no longer going up a lot every day. So
Right, and
kind of
then that
shifts
just
the
kind of
way.
factoring in into that equation too, of course. Baseline rate hikes, Brett. This is an interesting one. We've seen this one continue to tack higher. Um, 12 rate hikes now all of a sudden on the menu. More than 12 popping in for the first time in a while. You can see that less than 4 has fallen off a cliff. That had been the baseline scenario for the longest time. That's no longer the case. So now we are basically up to 7.4 hikes compared to that March meeting where they're expecting about 5. This is pretty much probably just in line with the hawkish rhetoric we've seen from the Fed officials. Would you agree?
Yeah, absolutely. The analysts, Wall Street, Fed officials, all on the same page.
Do you have a base case scenario, or do you think that the Fed's going to be relatively dynamic, and if they see things getting choked off a little bit too quickly, that they'll slow down?
I think that they're trying to hit a moving, very small target, and they're going to be, wiggling this dial quite a bit as new data comes in.
All right. Um, let's see. And then we got cash is king. We saw the absolute net percentage overweight cash at the top, commodities, second healthcare, after that, energy. So really materials, things that we've been seeing. Was there anything in this chart that caught you by surprise at all?
I find it interesting that cash is above commodities, but then again, not really, because again, as we talked about earlier, it's sort of like you're looking at the smoking crater that was the risk parity model. So
Right.
if you've got bonds or stocks, and they're both going down, and you don't like either of them, you think interest rates are going up and equities are going down, then the only thing that you can do is cash and commodities are tough to invest in.
Right. Next up, just taking a look at net percentage overweight sectors. Healthcare, which I view as defensive, definitely one of the big winners. I suppose, Brett, people are looking at that as if we are seeing inflation rise, people are still going to have to take care of the healthcare needs, where you could see discretionary all the way down at the bottom. I was a little surprised to see utilities down that low. I think that that'd be a little bit more defensive in nature and a must, but obviously energy and materials continue to see a lot of the money flows there. But that's why I thought the FCX and the Alcoa earnings reactions were so interesting. It certainly feels like we are seeing money fall out from that. And one of the things I thought that was going to be interesting, Brett, and why I kind of was just taking a little bit of a dabble in the NQ long was, would we see money flow out from these leaders into some of the other spaces? But curious if you have any thoughts about the initial reactions to some of the selling going on those market leaders and earnings, and what's your take?
My take is you're talking about historically the most cyclical parts of the market at a time when, we're seeing the thing that people are all consensus aggregating around is an expectation of a near-term recession. So I think that now is the payoff and is the time to start diversifying out of all those super cyclical plays if you think that the next around the corner moment is an economic growth shock starting to play in over the next couple quarters. Then you'd want to be getting out of some of these extremely cyclical plays. Now that may be wrong because there may be such price support for what Alcoa is selling that it ends up not being a function of the same sort of cyclical factors we typically see. But I think that it's kind of like the contrarian play now, the movement away from commodities. If you think that we're going to start to see problematic economic data.
All right. And then when you look at this commodities overcrowded, this has been the most overcrowded, overweight area overall for the last couple of months here. And you can kind of see the last time it was around this was in February 11th. So I think this plays out perfectly to that cycle that you're talking about here, Brett, where you have the tops in February 2011, then that long trough in there between 2013 and 2017, and slowly coming out of it. But as you can see, we're well above those February 11 highs in terms of in terms of where people are suited. So this could be part of the downturn cycle that you've been talking about if we start seeing recessionary signals. Would you agree?
Yeah, well, I mean, one would assume that that's how you played as an institutional money manager. If you think that we're headed toward a growth shock, then you'd want to position yourself outside of extremely cyclical exposure.
Okay,
But
moving
right
on.
now, they're overweight. So
Yeah, yeah, and as you can see, the most crowded trades, short U.S. Treasuries being another one. We're just talking about that bond allocation. Long tech stocks still in this group here. Long ESG, also short China, long Bitcoin. Is there any strategy in there that kind of catches your eyes, or that you're looking at as a trade down the road?
well, I think that if not really here. I mean, the short treasuries has been interesting to me the entire time because that's been a crowded short since the 10-year was at 1.5%. And it's just really interesting to watch that play out. I haven't really experienced that kind of move before, where you have something that's looks on every level super crowded as a trade, and yet everybody in it wins over in a big way. So that's been interesting to observe. But I think this chart, if you want to look at the next chart at the same time, I think the two together are pretty interesting to see that you know oil is the most crowded, but it's
Continues to be
also
the
the expected to perform the best.
I see that, Brett. I'm thinking buy dips and energy. I've been thinking that from the get go. Obviously, the recessionary backdrop and growth backdrop is going to be in there, but that's kind of what I'm looking at. I was surprised to see emerging market equities number two, given some of the performances we've seen in their currencies, the inflationary impacts, and a little bit more exposure to Russia and China, of course. So I feel like people keep talking about emerging market equities, and we were joking about this at the beginning of January. Feels like every year it's the hot pick for what's going to outperform, and we never see it here. So
Well, I'll
you
tell you
would think.
there's one factor to consider, and that is if you look over a very long-term chart, inflation is always higher in emerging markets than it is in developed markets, except for right now, oddly enough.
Why do
Across
you think
the
that is?
I'm not exactly sure. I guess because it's
Maybe central banks put it in less liquidity.
Maybe
So,
there's less disruption to supply chains simply because there aren't as developed supply chains. So it's sort of like, you know, normal life is still the same, which is, a far less efficient real-time economy. And so maybe there's more of a shift here. And I don't know. But if you look at a really long-term chart, you go back, 25, 30, 40 years, it's always the case that across the emerging market space, inflation is higher than across the developed world space. And that has changed right now. So inflation stayed about the same in emerging markets. In developed markets, it's gone through the roof. So that may be one of the reasons why people are looking for outperformance there.
all right. The Fed put. So this gets into our hawkish Fed commentary, Brett. Right now, on average, just based around these survey questions here, the Fed put seems to be coming up around 36, 37. That would be about 18% lower from where we currently are. I think the general theme from this is that the investor no longer feels like it can rely on the Fed. Probably a good thing too. Obviously, we've seen that with less risk going on, but you got any thoughts on the Fed put in some of the sentiment? Do you think investors are properly pricing in the Fed mindset right now?
Yeah, I don't know. This idea that the Fed put is at a certain S&P level has always been kind of problematic to me. Like I mean maybe that's sort of, you're taking in so many variables in that analysis that it's difficult to understand what's going through somebody's mind, because it can't just be that the price of equities has dropped to a certain point. What if inflation's at 17% when the S&P is at 3,500? Is the Fed put still there? I mean, it's obviously assuming that would be post growth shock. So also we've seen, a major downshift in inflation. We've seen, possible recessionary data building, and that's why the S&P is at 3,500. That's when you get the Fed put. But it just seems like a really odd way to look at it to me. I've heard, lots of people talking about which level of the S&P is there a Fed put, and I just have a hard time looking at things. I mean, I understand people have
See,
401ks, the Fed's going to protect
I
that,
don't,
but
I don't have a problem with this mindset because I do think that it just kind of takes over the sentiment and leads. I mean, number one, there's never
yeah.
been a proven Fed put. It's not like any Fed officials ever said, "Yeah, we're buying stuff as soon as we get to this level here," or anything like that. But I do find that it works into the mentality of investors and risk appetite based around this too. Like if we did start slipping down to that 3,700 level and things are looking awful and everything was at extreme, the idea of people starting to buy because the Fed isn't going to let this go down because it'll destroy too much wealth. I do think that that's a fair assessment. So from that
So it would
standpoint,
enter into the Fed's inflation projections then.
well, yeah, inflation, growth projections, everything
Sure.
along those lines for sure. So I don't think it's a ridiculous concept by any stretch, based around sentiment. And that's kind of how I look at it. Just like, okay, where are people thinking that they could get a little bit more aggressive on the idea that Big Brother is going to be there to help them out? And that's generally how
Granted.
I'm reading this. And when I look at it, you know, just because we've dipped down now to what 44.50 or whatever, obviously well above all these levels, but you know that doesn't mean that, oh, we've fallen 30 points, people are going to expect the Fed to kind of ease off. The Fed's definitely laid that out, that's not going to be the case. And I just view it as a way of trying to understand where people might start finding some inflection points where they're willing to flip to more of a risk idea because of what the Fed could do.
Yeah,
But
and we can segue from there to say, that's what the bearishness in all of this data, particularly from the institutional side of the market, is precisely because this number is much lower than it has been for the last decade and a half in terms of how far below the current price of the market, right? I mean, that's the point here.
right,
If there's a grand summary point to make in terms of the sort of macro analysis of this edition of the sentiment and flow show, it's that if that's at 36, 37, 18% below when we're already down 8% or whatever, in the past, people have been living in a world over the last decade and a half where that's just 5% below the market. And now it's 20 something percent below the market.
right.
And that's the point.
And this is already a market that's what, about 4 or 5% off from the highs too. So
Yeah, so we're
it does land into that bear market territory, I suppose, which perhaps that's why it's coming in. But yeah, I mean that's kind of the whole gist of it. That's why we had this as the last slide, just because this does kind of encapsulate the change that's going on. We're going from arguably the most dovish Fed of all time, pumping in trillions of dollars into the economy over the last 18 months or so, to now arguably the second most hawkish uh, Fed that we've seen. I even saw, I believe Powell invoked the name Volcker in his earlier comments today. Brett, did you
oh, did he
notice that?
really? I didn't see
Yeah.
that.
Yeah. So, obviously, I'm going to guess that the Fed's been doing a lot of studying around what was going on in the 80s and everything, which is really no surprise because that's really been the kind of underlying sentiment that's been going on. But
Well, it's
what,
also when Powell was a grad student, that's what was happening. Or,
yeah,
the inflation of the 70s and the way that it supposedly was cured. I think it's a lot more complicated than Volcker taking up interest rates forever. But I mean, there's a whole lot of other things that contributed to the disinflationary period that followed that. But that was the lesson for everybody coming up in his field, was this is what you do under those circumstances. And I think everybody at the Fed, that's the one thing they know for sure, which is why I struggle with people saying, well, the Fed is just always going to print money no matter where inflation is. I just don't see that. I think everybody on the Fed right now knows the one thing they know for sure is that what Volcker did needed to be done.
right. Right, and you see that playing out, and you see that in the repositioning. So I guess the thing will be, Brett, what levels can they get up to before we start seeing it really impacting the data and the markets? And so far, there hasn't been any signs of it impacting economic data. I haven't seen any sort of report that's really flagged as a, oh wow, things are really slowing down here. And so far, the
Right?
early signs in the earnings reports haven't flagged that either. So this is going to allow the Fed to continue along its path and hopefully get in a couple of rate hikes, because they do need to get it back to a normal level. I think I saw something where that 18 trillion in debt, Brett, that had been in negative territory was now down to 2 trillion. Did you see any numbers on that by chance?
On what? Say it again.
The number of debt that was out in negative territory around the
Oh
globe
no, I
had
didn't. Well,
had declined from like 18 trillion to
yeah,
2
I bet.
trillion. I got to
Sure.
get confirmation on that number, but that's how markets should be acting. So,
Yeah.
I think it's probably disingenuous to say that the Fed's getting very hawkish. The Fed's moving back to more to normalcy, I would say.
It's all relative though, because
It is all
everything
relative.
acclimates
True.
around a context, and then you change that context dramatically. I love my favorite analogy ever for this is just to think of, try to take all of the species of animals and fish and plants and stuff that live at a mountaintop lake with no salt in it at all, and see how they do if you drop them in the ocean. You change that salinity level and everything dies. If you can move them just a little bit of salt, but if everything is evolved into that niche where there's a certain very steady state absence of some factor, and you start to introduce it, it's all relative. We've had a mountaintop lake kind of world in terms of interest rates. We've had zero, zero, zero for a long, long time. And everything has grown up in the system around that assumption. Everybody's super levered off of that idea. There's all sorts of money management strategies involving trillions of dollars that are run by people who only know that kind of environment. Everything is evolved into the niche of
Short
zero interest
vol
rates.
being a perfect example of that.
All sorts of things. It's so complicated into the plumbing of how many different systems have evolved to live in that kind of niche. And then you take it from there to 4% on the 10-year over a few months. And that dramatic change in that context is going to, as I said on a strategy call we had in, I think, early December, I said, if we see that kind of thing, you won't know what's going to break, but something's going to break. You
Yeah.
can't make that kind of change in a system that complex that's evolved into place like that and then not break. So
And I think that pretty much sums up exactly why we're leaning on the bearish side of things, just to allow this to kind of play out. Not that we're expecting everything to die, though, Brett. We want to be clear
No,
on
no, no,
that.
no, no.
Right?
Yeah. And again, I feel like, I'm short. I didn't sleep very much. One of my kids was sick. And, I mean, I'm going on short sleep right now, and I'm short, the NASDAQ, and I'm short the Dow. And I just wrote the chart book, which expressed some of these views. And so I've kind of been marinating in this thought cycle, and I may be presenting an overly bearish kind of vibe right now. So, atone for that in your mind as you're listening.
Right, but the general thought process is here is to remain cautious, to be patient, wait for names to come back to you because they likely will in this environment because we got to work through some of the liquidity. So I think that's going to sum it up for us here, Brett. Unless you have anything else that you wanted to add to the conversation.
No, no. I mean, we lost those two safety nets, dividend yield versus interest rates, and the Fed. Those two puts that have been sitting on the market for a while, and there's an adjustment that's going to happen, and people are pessimistic. And I would just say, right now
Rightfully
the way this
so.
right now the way this market is operating, it's the moments of excitement and the upside breakouts that you want to be selling. At least that's my view. That's been working really well for me, rather than buying into breakouts above levels, unless you start to see that work, because it's probably just shorts getting stopped out rather than real money coming in.
Right, and then the idea also on sentiment hitting extremes. While they are at extremes, it's probably a little bit more group thinking. It doesn't necessarily mean that that's going to be a contrary indicator this time around, given some of the liquidity conditions. Would you agree with that?
Yeah, sure. And intraday trading, know that the short side can get crowded pretty quick. So, don't
Right.
wide stops, shorting breakdowns, or you're going to get hurt too.
Yeah, yeah. So opportunity to make money on both sides, but
Yeah,
overall,
it's
just kind
great.
of continuing to lean. Yeah. So
You can
it's an
make a lot of
interesting
money in a
time right
market
now.
like this.
Yeah. So, all right, Brett. Well, I think that's going to do it for us over here. For all the subs out there, we are going to pause Trader Audio for a moment. I am going to be posting a little bit later this conversation here, and also, of course, restarting up audio to take us home for the final hour and a half of trade. So, Brett, thanks for joining us as per always. Good to chat with you about the markets here, and look forward to following your commentary on the site.
You got it. Thanks, Gav.
All right, talk to you soon.
Take care.